So, child's life insurance. Should you get it? Should you not get it? Complicated question to answer. And that's not necessarily a question I'm trying to answer here. My goal with this quick video is to give you a sense of how I think the product is positioned, both to end consumers and to advisors from the insurance company perspective. I recently sat in on a CE credit educational session with Equitable Life. And they were presenting the product, specifically participating life insurance, which anyone who follows me knows that I have a big problem with. I think it's kind of not the idea of permanent insurance, just how it's structured and the transparency there. But Equitable Life is effectively positioning the product to advisors to position the product to their clients who have children and believe in permanent insurance as an asset class. And what's interesting with me is that the session was twofold. First, focusing on how to position and how to sell the product, and then the second, focusing on the numbers. And I think that's very reasonable. Everyone in sales should get training with regards to the best way to position products. And then after you're done positioning the product from, let's say, a storytelling or emotional perspective, you got to then get to the steak, the meat and potatoes. And this all goes back to sizzle versus steak. And anyone who's been in sales long enough understands that you have to have both, right? You got to have the sizzle. You got to have that emotional side of things. When the waiter brings that food to your table, you want to have that, you want to hear it. That makes you hungry. The smells, that's the emotion side of thing. But at the end of the day, as great as the steak could look, as great as it could sound, if you cut into it and it's rotten and it doesn't matter how great the story was. It doesn't matter how great you did as a salesperson at evoking emotion. The first part of this presentation was effectively about that. Ironically, when it comes to children's insurance, the whole presentation has nothing to do with insurance. Meanwhile, that's what you're selling. And this is my problem with permanent and investment grade insurance as a whole. Rather than focusing on what it is, which is die money, you focus on it as an asset class. And the reason why they do that, here's what I believe, is because it's really hard to sell insurance emotionally because people, generally speaking, don't like to talk about death. Totally makes sense. So how do you avoid that? You talk about it as an asset class. Now, the reality is I have two of these products for both my kids. My daughter's 11 and a half, my son's 6 and a half. And if I could go back, I don't know if I would buy permanent insurance again. I probably would, given how long I've been in the business. Sadly, the first ever claim that I had was a child. So I do see the value in children's insurance to lock in on something while they're young, to provide it if, God forbid, something were to happen. But I've changed my mindset on insurance as an asset class, which is exactly how it was presented. And for the insurance company in this case, that was the whole story. Bring and present the product to your clients as an asset class, which I get it, but the story may make sense. But what if the asset class is just we're not talking about your kids now, we're talking about it in the future. Now, the one thing that I agree with is the idea of locking in on something when you're young. And if you've checked all the other boxes and if you have free cash flow, I'd say do it. You're doing the RESPs, you have investments for yourself, you have your own house, you have money, you have a plan in place, whatever that looks like. You still have an extra few hundred to few $1,000s a month that you don't know what to do with. You're looking for some tax sheltered growth for your kids. You want them to have insurance in the long run, fine, go for it. But the idea that this should be presented as an asset class, when all those things aren't in place, that's my problem. And way too often, when people reach out to me asking about my thoughts on insuring their child, I don't have an issue with them insuring their child and using it as an asset, even though I think it's a crap asset. My issue is that usually these people don't really have anything in place for themselves, whether that's more term insurance or good investments for them in their own future. The reality is, if you don't have a lot of money or if you don't have a lot of investments, I think you're better off putting an extra $50, $100, $200 a month into your own term insurance rather than focusing on creating a long-term asset for your children. And of course, at the end of the day, why do we sell these investment-grade products? Here's my cynical opinion here. It's all compensation. Now, I'm not saying that your advisor is selling you this product only to make money. Of course not. But whenever you're thinking about sales, especially in financial services, you also have to consider the incentive model. $1,000 a year in insurance premium pays me basically about, here, I'll run it for you based on my own commission structure. 1,000, 50% of that is my first year commission times 1.85, which is my bonus, plus 500, 1,425. So for every $1,000 a year I sell, I make about $1,500. Ironically, if an investment advisor sold $1,000 a year in the form of an RESP to one of their clients, they're lucky to make 1%, $10. The incentive's there. And these, I hate to say it, the reason why I believe these products are so popular has really nothing to do with the fundamentals. In the long run, these illustrations look like relative to what is actually being presented at the time of sale. A lot of it, in my opinion, just has to do with the incentives. What was really interesting is that during the presentation, Equitable Life in this case mentioned how the best advisors who sell this product highlight a specific age or highlight the age of the parents. And in this case, they highlighted the age of the person paying in premium as currently being 34. So let's run the numbers here. And I assume 10% in the S&P 500 in the index as the easiest 10% per year you'll make on your money over the long run. Obviously, it's not a smooth 10%, but it is an easy 10%. So let's go with this. $200 a month, every month for 12 months, starting with nothing, 10% in the index at age 34. $685,000. Why the hell would you buy an insurance policy as an investment when your kid would have $140,000 when they're at age 34 compared to $685,000? Now, when would I do this? Let's say I'm already doing $200 a month in RESPs. I'm doing $200 a month for myself and other investments. I already have a house with a small mortgage. I already have a significant investment portfolio. I have a few $1,000 a month that I burn or don't know what to do with. I have easy cash flow. I'm not living month to month. I'm financially stable. Sure, buy insurance policy for your kid because you like the idea of them having some permanent insurance down the road. And let's be real, someone who's age 34 is not going to get a $730,000 permanent life insurance policy. It's just too expensive. The older you get, the harder it is to justify. So if you want to view this as a luxury item for your kid to have in the future because you're so financially stable, fine, go for it. But the idea, this should be presented as an asset class and you can use to buy a house or leverage to buy a house, like horseshit. The numbers don't lie. $140,000 versus $685,000 just by putting $200 a month into their RESP or your TFSA or non-registered account as an investment doesn't make sense to me. Once again, sizzle sounds great, but the stake is just Here was another very interesting scenario that was presented, and here's the situation with the parents. Now, keep in mind, these are just generic scenarios. I don't know the backstory. Parents are 35 each, own $1 million of 20-year term coverage each. Just had a boy, $6,000 in total deposits. So they were paying the base premium and they're paying the additional premium. And the idea here is a hybrid investment strategy and insurance strategy. So the parents buy the policy on the kids, but use the policy to supplement their own retirement. So what does that look like? Well, when the kid is age 35, they can draw $25,000 a year for 15 years. Meanwhile, the policy is still in place on the kid. I think that this is probably the worst thing I've ever seen in my life. First of all, let's look at the fundamentals of the situation. If you only have $1 million a year each in term insurance, I would much rather someone get more term insurance for themselves and invest for themselves rather than buy this. But let's, for sake of argument, just assume that they're financially stable, have the money, have other assets. It's really not a big deal. Why would anyone in their right mind buy this when you could mimic this strategy through a non-registered investment outside of life insurance? So let's run the numbers here. $6,000 a year, once a year. Starting with nothing, 10% in the index, and they put it in there for 20 years. In year 20, that's $343,000. They stop paying for it after year 20 because it's a 20-pay insurance policy. That becomes the new present value, no more payments. Age 35, 15 years later, $1.4 million. You could then borrow $25,000 a year off of your $1.4 million portfolio rather than borrow $25,000 a year from your participating life insurance policy. Now, you can say, well, Adam, 10% a year, that's a little bit high. That doesn't make sense. What if the market doesn't do it? Well, I believe it will. And at least I'm sharing with you my predictions. And that fundamentally goes to the primary issue I have with these policies. Everyone thinks that in the long run, these are a guarantee. But the reality is they're not. And the problem is the dividend scale interest rate isn't a rate of return. Here's the returns of the actual account. This is not what you get. You get the dividend scale interest rate, but this is not an actual percentage. And this is my problem with these products in principle, even if you have the money to buy them. If you put $1,000 into something and you're told you're going to get 6.25%, that should mean around $60. The returns would be $60, but this is not $60. The dividend scale interest rate represents the accuracy of predictions. And my issue is that I have all these old policies on the books that 20, 30, 40 years later, they're worth a fraction of what was promised to them when it was purchased. It's hard for me to get behind something when all I see is crap the longer something has been on the books. Now, if you have tens of millions of dollars in wealth and you're using this to replace a bond fund, fine. That actually makes sense to me. I still wouldn't buy it as a matter of principle, but if you have so much money that you don't know what the hell to do with, you're paying to tax, and you want to dump money into these products because you want that bond coupon over the long run without the tax, that is one of the scenarios which I think it makes sense. But for everyone I speak with, there's never been anyone that I've spoken with where I feel like it makes a lot of sense to buy this for their kid outside of just doing basic investments. Or you just like the idea of having some life insurance for your kid. And the reality is, for me personally, I do like the idea of my kids having permanent insurance for themselves in the long run. Would I do it differently? Yeah, but hindsight's 20/20. And the numbers don't even work out over the short term. In this, towards the end of this presentation, Equitable Life said, hey, let's look at policies that were sold 10 years ago. And the reason why they're looking at policies that were sold 10 years ago is because I guess they don't want to pull up policies that were sold 30 or 40 years ago. They wouldn't look nearly as good. But let's run these numbers, $1,309 a year, starting with nothing, 10%, over 10 years, $20,000. Meanwhile, cash value in year 10, $4,000. Like, which one makes the most sense? Which one? In fact, if they would have just bought the index, they'd have more money. This is exactly what Chatty said. You put that much money into the actual S&P 500 and you deal with the hills and valleys. Now it's assumed a 13% average return because that's the approximate total annual average return between 2014 and 2024. My point is simple. Life insurance is only an asset class for the super wealthy. If you're not super wealthy, focus on your investments. Because the reality is, over the long run, these products will perform like relative to what you'll have in the actual market. Thanks very much.